All right, everyone, welcome to Rule Classroom. I'm Albert Liu, and I got a treat for you today. Joining me all the way from Istanbul is my friend Joel Litman, who's the founder of Altimetry, and he's got a new call that I want everyone to know about because, well, first let's say hi, Joel, and then I'll give him the background, kind of our history. How are you?
Albert, it's great to see you. Great to see you, man.
It's great to see you. Joel and I have been friends for many years now, and it goes back to when I first started working for Rick Rule, and I was running the conference in Vancouver. And there was one year in particular, I think it was 2017 or 2018, Joel. I think it was
Yeah.
2017. We had a great lineup. It was the early days of James Rickards, and we had David Stockman, I think, for the first time. And I put these guys up, and maybe Bill Bonner was there, or Doug Casey, and Rick came to me after and he said that those talks were so depressing, one after the other. They were just so negative because you have to give the audience some hope other than gold. And I did an interview with Dave Stockman, still one of my favorite interviews today, where he says, like, sell the house, sell the wife, sell the kids. It was really funny. But he was right. So after that day, we went out and we got Alexander Green from the Oxford Club. We got Steve Sugarroot several years in a row. He actually said,
Sugar.
"Sell your mining stocks one year." So just to have an independent voice, it's always good to have someone who looks at things differently. And so that was right around the time Whitney George introduced us, and I thought, oh, this is a great fit for what we're
Yeah.
trying to do here, because your research is rigorous and you're just very objective in the way you look at things. And so anyway, that's the history. But the entire time I've known you, you've always been very bullish on the market. Um, and you made great calls, but they've always been bullish calls. And
Well,
I
the
saw
signals,
something.
the signals have
Yeah,
been very
absolutely,
bullish. It's
absolutely.
not a personality thing. It's that we've got data and signals that we're different from, I think, what other people are looking at, which maintain
Exactly.
that bull call. Yeah.
Or different than what yeah, than that we're presenting on week to week. And but I saw something from you on LinkedIn, uh, which you had code red warning on U.S. equities. It was
Yeah.
I wouldn't have blinked at it if it weren't for you from you.
Yeah.
But because it's from you, I want to know, what is the deal, Joe? Why are you negative at this time on equities?
Well, the signals are telling us to be so. And so while we were so bullish in March, April, May, June of 2020, when people were talking about the pandemic and the lockdowns were just beginning to get rolling, and we said, look, in this case, the U.S. economy and the S&P 500 are not the same thing. There will be a number of companies that are going to do very, very well. Big companies are going to grab the business that the smaller companies that can't weather the storm are going to lose. That was a very bullish call. Going into 2020, though, we did see some sentiment indicators that were high, and we said, look, we think the market's expensive at the beginning of 2020, but we said that's okay when you love the fundamentals so much. Right now, 2 3 weeks ago, we saw sentiment indicators that are at 10 15-year highs. We have a price to earnings multiple that, as we measure it, because we're using uniform accounting, look, that Cape Schiller method is just useless. It's been telling everyone the market's expensive for like 7 years straight. What good is that if it gives you the wrong signal 7 years and it gets it right in the seventh year? Big deal. Um, Whereas our uniform accounting calculation of the PE indexed against interest rates and inflation and investor taxes, which is what every PE needs to be indexed against, not on its own. Meaning a 25 times PE is not expensive if you have low inflation, low interest rates, and low capital gains dividends tax rates. A 25 times PE is very expensive if you're going into high interest rates, higher taxes on investors and people and whatever else, and higher inflation. And given that context, both from a valuation standpoint and a sentiment indicator, it says things are getting very, very expensive. Add to that credit breaking down at levels we haven't seen since 2008. 2007, 2008, credit broke down, and corporate credit specifically, not US debt, not consumer debt, not student loans, but corporate debt, because we're not talking about buying the US economy. We're talking about, do you buy US equities or not? And corporate credit is breaking down at levels we haven't seen in 13, 14, 15 years. That gives us pause. And that's why after I don't know how many very sometimes controversial bull market reiterations and buy the dips calls. This is not a buy the dip call. I think we're going to look back and we're going to look at September and August of 2023 being the double top from September of 2021, October of 2021. And this is the double top before a long sideways to down to deep down market. And it is not the time to be in just a plain old US equity fund unless you have a very, very long term view.
Okay, so tell me if I'm wrong, and I probably am. But it sounds like a lot of this conclusion can be reduced to the interest rate environment we're in now, and the fact that you believe that we're going to be higher for longer. I mean, is it as simple as that? When you look at corporate debt, when you look at multiples, tell me how much of
Yeah,
it
Albert,
just boils down to that.
well, it's a big part of it, but it's partly the Fed reacting to other things that we're also looking at. And so, the Fed trying to cool off the economy is because we did see bond issuances and leverage increase at unbelievable crazy levels because of 0% interest rate, as if that zero is going to last forever. And so we've seen corporations take on a lot more debt. I don't think we're going to see the bankruptcies that we saw in 2008, 2009, and following, but we're definitely going to see the cost of debt go up at levels a lot of companies didn't expect. That's going to take away from earnings. That's going to take away from what investors can possibly make. And because of all that, um, which also leads to why the Fed wants to cool off the economy and slow down inflation, you throw all that in together, and we say, yeah, that's why the U.S. stock market has a lot more downside than upside.
Why don't you think we're going to see the bankruptcies?
Um, I think we're going to see a lot of consolidation in regional banks. So maybe they don't actually go bankrupt, but they're forced to liquidate. I think there's a lot of assets companies have that they're going to be able to sell off. I think they're going to slow on growth initiatives that they'd previously expected because they have so much debt service to cover. However, we don't see anything as bad as the bankruptcies that were brought in 2008, 2009, because companies, while they're going to be in it, they're indebted, if you will, with debt, they might be able to cover their debt service. And there might be some level of refinancing environment to allow for that, but it's just going to be really, really expensive. And it's going to take away from corporate earnings. It's going to take away from corporate growth. It's going to take away from expansion. And you throw all that together, and that means earnings keep getting revised downward on a price to earnings multiple that is way too high given the current inflation, interest, and tax environment. And that leads to what is the biggest bear market call I've made since really since 2008.
Okay, and your thoughts then on the higher for longer, uh, you know, feelings?
No,
Is that, do you believe that? Is it though? How do you think the Fed is going to react once this starts
so
happening?
Albert, I started out as an accountant. I became a forensic accountant. That got me into investment research and investment analysis. And so, our firm is about 150 people. And one of the things that we built was a earnings call forensics, where we every stock or bond that we look at, we'll talk to management, not talk to management, but listen to management, as if we were talking to them, asking the questions that we want to ask and hear what they're saying. And we use a cognitive and emotion function. It's a proprietary technology we built that looks at and measures cognitive and emotional affect and voice. And guess what? We run this on the Fed also, not just on companies and management teams. And when the Fed talks about that 2% inflation number, man, are they emotionally attached to it, meaning they are affected. Um, and I don't think inflation is anywhere near 2%. So you're the Fed, and you have this unbelievable attachment to this 2% inflation level that you want to get to. You believe slowing the economy is necessary to get there. And raising rates is your only real tool. You believe that you have full employment, if not super full employment, really, really low unemployment rates going back, right, 20, 30, 40, 50 years. And you say, well, that tells me we should keep, the Fed should keep raising rates. I'm not saying it's the right thing to do, but I'm saying that's what we think they're going to do. That means the expectations the Fed's suddenly going to drop and reduce interest rates because they're trying to help the economy when there's super full employment and inflation is still where it is. We think their biggest metrics that they talk about and that they get very emotional about are going to be their targets, and those targets will lead them to keeping rates at elevated levels for some time, at least long enough that it'll turn the economy to recession, reduce corporate earnings, and kill valuations for some time. And that means 12 months to 36 months of very, very, very bad news for U.S. equities.
Okay, what about on the fiscal side? Any tax relief, you think? Maybe next year or the year after, 2025?
The U.S. is actually in a very good tax revenue situation, believe it or not, even given the debt levels. And this is one place where I differ with a lot of economists who I think fail to understand accounting at a deep enough level. Government debt service, the 30 something trillion in debt and debt service, even at 5%, is manageable by the US tax base. And that's what you have to think about. I see these ridiculous GDP numbers and debt to GDP numbers. And I'm like, governments don't pay their debts with GDP. China doesn't pay its debts with GDP, they pay with tax revenue. And if you have sustainable tax revenue, which the US has over a long period of time, because US is actually at lower tax rates than a China or a Russia or others. Russia, when you add in all taxes, not just their income tax, but other taxes that are determined by income, which they don't call income taxes, they're at unbelievably high tax rates. And so US has a sustainable tax level that for the long term is enough to be able to service the debt levels, even at the elevated interest rate levels we have right now. Now, if interest rate went to 10%, that'd be a different story. But at 5% range, U.S. taxes are more than sufficient to cover U.S. debt service. And so we think that we don't necessarily have to have an increase in tax rates for the U.S. to be able to cover its expenses. And that doesn't mean that the irresponsibility of U.S. politicians isn't off the charts and anything can happen. I don't trust U.S. politicians to get their job done right, but their irresponsibility is bailed out by the strength of the U.S. economy and the strength of the U.S. taxpayer year after year after year, and will continue to
Okay.
be so for a long time to come. So, Albert, what you hear me saying is we're still very, very bullish on Pax Americana for the next several decades, on the U.S. being the dominant hegemony of the world by far, for the next 20, 30 years. But for the next 2 to 3 years, I don't think, maybe 4 years, I don't think you can stomach just leaving your money in the S&P 500.
Have you set targets on where you expect the S&P to be in three years?
No, that's hard to say. I mean, people have asked us, should you short stocks? And I said, shorting is expensive, first of all. Second, any amount of momentum, you get your face ripped off, right? Instead of shorting, because what if the market just goes sideways to down? That's still bad, right? For 2 or 3 years, but doesn't actually
Yeah.
go in a bear market 30, 40% down, because it's possible that it is not as bad as 2009 and we don't see 40 plus percent 2009, 2008, from the peak in '07, that we may not see 40, 45% down markets. But it's still going to be nasty. And so, if you ask me, I'd say it's somewhere around 15, 20% down, plus or minus 20%, right? Meaning it could be it's just a stable stock market, it just goes sideways, and it could be a fall. So our belief is right now there's a time to turn towards individual corporate bonds, because the bond markets and credit signals are already in code red, right? Credit default swaps and interest rates are very high. You're getting signals that look as bad as, I'll say, late 2007, early 2008 for credit signals, that we haven't seen literally since then. And that's why this is a very different bearish call than I think I've had some technical bearish calls at times in the last 10, 12 years, but nothing where both the fundamentals of credit, which is really the canary in the coal mine of U.S. equities, lining up at the same time as really expensive sentiment indicators and valuation indicators.
Okay, very interesting. So, okay, so you don't like the stock market in the short term. Um, where are you on inflation? I know, like, you think the Fed is going to hold the target at 2, but right now it's between 3 and 4. Maybe it might go higher. You probably don't want to send cash either, right?
Well, here's why I anger your viewers and your listeners, Albert, and I'm sorry if I do. I hope that doesn't discount anything else I'm saying, but we don't believe that inflation is coming mainly from QE of the past years. Um, we think the main reasons for inflation are still supply chain issues. It's deglobalization of China and Russia, right? When you have a world that's non-China, non-Russia, and we're getting so much cheap goods and cheap fuel, we the world, from China and Russia, and the world is reorganizing itself around that. That's going to make things get a lot more expensive purely for demand supply issues, which the Fed actually might be able to control somewhat by rising interest rates. That gives, hopefully companies some time to reorganize and find other cheaper areas of the world. So you have these crazy, incredible markets. Right now, Mexico is now the number one trading partner with the US. It is no longer China. This is just after what, 1 month ago, 2 months ago? Mexico is the number one trading partner. And that's been a long time coming, but that's part of the fallout
Joel,
of
we
what's
could
been going on.
yeah, but that's the macro. I think we should do that on another call because you got to take into account the exports from China to Mexico too, right?
Yes, yes. Now that said,
And
that
those have
still is
skyrocketed over the
no.
same
Yes,
period.
yes. No, and that's yeah, and of course the Russian imports have fallen, but the exports from Germany to Azerbaijan have gone up 1,000%, or Kyrgyzstan have gone up 1,000%, or through Turkey, right, or Istanbul. So yeah, I'm in agreement that,
The
that
goods are
that's there,
just
but that's
redirected is what it.
yes, but that
Okay.
still means more expensive. That still means more expensive, and
Yes,
that's a large
absolutely more
reason.
expensive. Yes,
And that's why
yes.
we're saying we still see inflation to be elevated for a while, and we think the Fed is going to keep fighting it for a while. We just don't think that it's coming completely from QE or from money printing, the way I think other people have thought, which is one of the reasons I think gold has not performed as people thought it would perform, because it's less from QA and more from supply demand issues. Gold benefits from a QA driven inflation. It doesn't benefit as much, and I know I'm speaking to the choir, it doesn't benefit as much from supply demand issues. Um, I don't think that we don't think our signals are showing that it's all from QE so much as supply demand concerns, the
I
inflation levels
agree
that we
with you
see.
100% on that, Joel. I don't think anyone would be upset with you on that comment.
Mm.
That makes complete sense. I think I would object if you said that QE had no effect on inflation. That's
Oh, no,
usually
no,
when
that's
we
not
come
that.
in and but yeah, the fact that there's a supply and demand for money, but there's also a supply and demand for goods, right? So I
Yes.
mean, the supply for goods is obviously being affected by all this. Okay, so but where are you on cash though? Cash, earning 5% on
No,
short-term treasuries.
I so the reason is you could do much better, right? And so the as you know, we just launched a new. We released this research just in the past week, and with that, we released a new investment research product, which is recommending very specific corporate bonds. We've been doing this for many years for institutions, but under the Altimetry brand, which is for retail, rank and file, individual and family investors, we are recommending specific bonds, specific QSIPs that you can buy in Schwab or Fidelity or E-Trade. You can buy them as easily as stocks. And I think that's where we see a dislocation, that my biggest institutional clients are moving there. And we don't see individual and families taking advantage of this, where you can get 10 to 25% returns, right? Double, triple, quadruple, quintuple what that 5% is. And by the way, the 5% probably at or below inflation. So you're still losing money at 5%. Whereas at 10 to 25% plus, you can make money. And individual corporate bonds, not bond funds, but individual corporate bonds, there's a lot of really, really interesting names out there that remain mispriced. We can buy way below par and get the capital gains as well as a phenomenal yield. Why sit in cash when you could do that?
Okay, so just explain to folks. So there are bonds that are trading at a discount now that you feel. So the yields are what at this discount? What kind of current yield are we talking about?
Well, so one of the ones we've been looking at is Twilio. Twilio is a company. Um, Under GAAP accounting, their earnings, as reported by generally accepted accounting principles, look negative. That's as reported, so they look negative. Well, any Moody's, Fitch or S&P credit analyst who doesn't understand how to really tear apart financials, which they don't, because they are paid for by the companies, right? And in many cases, all they do is peg to the credit default swap anyway. So if the CDS is wrong, then the credit rating is wrong. So Moody's, I don't know, they have Twilio's bonds, one of their bonds is being ranked double B rated. I'm going to tell you right now, there's no way that that particular bond isn't investment grade, given the maturity date, everything else. Meanwhile, when we recommended it, it was trading at 820 on par. So You could buy $1,000 bond at 820, and as long as it's good money, which it is, lock in $180 gain on 820. On top of that, the coupon was 3.7%, so the yield effectively at 820, I think you're getting something closer to a 7.5+% effective yield on the bond. And it's a good money bond. You don't have to worry what the stock does or whatever. Where did Moody's mess up on giving them a junk rating, which doesn't deserve to be junk? I think they're just worried about credit in general. I think they look at a company with negative earnings and they think that negative gap earnings is meaningful. My goodness, if you shorted Berkshire Hathaway every time they showed negative earnings, you'd go broke, right? Because so many times Gap will make a company because of stock options, because of mark to market goofy rules, because of all kinds of acquisition accounting and other issues. It'll make a company look like it has negative earnings when it doesn't. And I've been an accountant for 30 years, right? As much as I've been a finance person. Um, when you look at the accounting under uniform accounting, this company's making money. Their money is good money. Moody's misses it. It's created some dislocation in the market because it's not being ranked as investment grade. That means all the big pensions that have to buy investment grade as per Moody's are not allowed to buy the fund, buy the bond. And we can find these dislocations. Say we know what the dislocation is. We know all these funds are literally not allowed to have clients. They're like, I wish I could buy that bond, but I can't because if Moody's says it's junk, I'm legally not allowed to buy the bond. Says XYZ pension, state, teachers association, you name it. And so we find these. You just sit on the money. And in many cases, you don't even have to wait till maturity date. That in many cases, the bond market or some hedge funds will figure it out. The bond will trade up, and you can get out of that name and get your capital gains in a year or two, and not have to wait till maturity of 3, 4, 5 years, while you clip this fantastic coupon along the way, which is far better than some money market yield. So no, there's great opportunities like that we sign left and right, and our best institutional clients see it, and rank and file individual investors don't realize you just type the QSIP into Schwab and you just buy it at 820, right? Like you would any other security, and then you generate that yield.
Very interesting. Now, several years ago, we had the energy crisis. We had the whole implosion and oil.
Yeah.
It looked like we were going to have a similar, like U.S. oil. It looked like we were going to have a similar instance here, where these things were going to come crashing down, especially the debt market, and it didn't. Right?
So
The banks worked with them, or something happened, and just like I remember the newsletters were actually or people were raising money for funds for these
yes.
distressed bonds funds and all that. It just didn't happen. So can you talk about why it didn't happen then, in your opinion, and why you think now is different? I guess
Yeah.
you're already seeing that's part of it. You're already seeing it, I guess.
So one of the things one of our institutional clients went to us and said, look at this crazy sell-off in oil and gas bonds. And across the biggest oil and gas companies, there was 850 individual liquid bonds trading. I think people don't realize that there may be, 5,500 liquid stocks that you could potentially buy, but there's something like 500,000 bonds that you could buy. And so when 5 bonds sell off, they'll drag the 6th and 7th and 8th bond with them. And the bonds that get dragged down could be senior secured, good money, right? Stand in front of everyone else. Sometimes, backed in other ways with some great covenants. They're covenant, not covenant light, but covenant strong. Like, there's no way the company isn't going to make this payment, no matter what happens, right? No matter what happens, this bond is going to get paid. And so we scoured through those, and we found something like 20 or 30. And the returns on them ended up being not just 10 to 25%, but there were double baggers in there. I mean, you had payoffs that were like stocks because they traded off. I think we're going to see that opportunity again, Al. Meaning we're going to see not just this Twilio or something where you're getting a 10 to 25% kind of yield, total yield, but we're going to see 50% and doubles in the bond world, where we'll see bonds trade down to 500 on par, and say, first off, you're going to double your money on the capital gain on the principal, and you're going to get this incredible yield on top of that. We think we're going to see that happen again. That happened with oil and gas, meaning that specific corporate bond worked because you weren't necessarily waiting for it to get fully distressed. You're just looking for mispricings. And so There are some of our clients, and I mean the institutional and Albert, all 10 of the biggest 10 investment managers are using our work. Maybe 230 of the top 300. So we get to have these great discussions. Um, yes, there are people already lining up for totally distressed bond funds, which, as you're saying, sometimes doesn't work. But building something for the upper end of high yield, meaning companies like Twilio, where it's being ranked as junk, but it's really investment grade. Well, I don't call that distressed investing. I call it mispriced bond investing because it should be investment grade. It is investment grade. They are going to pay off. It's crazy that they're getting ranked double B, right? It's crazy that it's being ranked double B. Victoria's Secret's another one that we saw the same thing happen. That they've got these bonds that are paying off, and you look at this, you're like, this is good money. The cash flow is there, but they're using some goofy EBITDA metric that Moody's is using, which Warren Buffett even said, if you're using EBITDA, you're either counting yourself or you're counting others or you're counting yourself. And Charlie Munger thinks EBITDA is one of the worst measures on the planet. And how does Moody's, S&P, and Fitch rank bonds? Based on actual net income, which no great investor would ever rely on, and based on an EBITDA calculation, which is so ridiculous, no great investor would ever rely on. And you get these opportunities because of it. And so that's because I'm with you on that. We may not see this wonderful, incredible, super distressed opportunity like we had in 2009 and 2010. You might just see dislocations. That'll be great. And I think that's where you'll see some smarter money going to, not the fully distressed, about to go bankrupt, make a big bet kind of thing, but saying, no, let me just go clip a really good 10 to 25% and occasionally 50% while I weather out the storm, over the next couple of years.
All right. Very interesting, Joel. I mean, it's people are always looking for alternatives now, especially like you said, when the inflation is not driven by money printing, or if there's other reasons for the price increases. Gold holds value, but it's not gonna respond the way a lot of people are hoping or thinking.
Yeah.
Um,
And it doesn't
so
pay a
yeah,
dividend. I mean, it doesn't pay interest. I mean, that's another reason why I like these corporate bonds for this kind of recession-proof stuff is that you're going to get that interest yield, right? A coupon, but you're getting a better yield because you're buying it far less than par. And then on top of that, you get you get the capital gain, right? Often before maturity.
okay, all right, cool. Joel, you have a presentation that people can watch, right?
Yeah, there's a link for that, Albert. What's the link?
I will post it in the description for this. Uh, Sorry, I don't have it on my fingertips. Disclosure: I'm an affiliate here. This is something that I'm working with Altimetry on. Very happy to do so. I don't do this with other writers, but I think the work that Joel does is he's very rigorous and honest guy. I'm happy to work with him on this. So the link is going to be in the description. Joel, what do you talk about in this video?
Well, we talk about a number of the signals that we're seeing that are breaking down. We have proprietary credit signals that we look at. The existing published credit signals are as bad as CAPE is for a PE. So the CAPE Shiller metric for the price earnings multiple, number one, it's based on as reported GAAP income, which is not trustable at all. Number two, it's based on a 10-year, but an 11-point moving average, which one would argue, was that just a back test that made it look good? Meaning, it was curve fitting. Why 10 years? Why not 5 years? Why not 15 years? Right? Why not a full market cycle? So the very fact that it's using 10 years, given we've had a much longer than 10-year bull market, makes it non-usable. Number two, it's based on a PE that doesn't make sense. So when you do uniform accounting and you look at price to earnings multiples and then you index against the economic environment, you get a much better understanding what's a high P and what isn't. The other thing that I'll talk about a lot about is how important credit is, and how the biggest funds that a lot of some of the richest people in the world focus on credit. I'm still beholden to The Intelligent Investor, and Security Analysis by Ben Graham. The biggest value investors in the world are all beholden to him. And I don't think people realize when you read those books on being a great stock investor, how often he mentions, they mention, Graham and Dodd mention debt and credit. It's every other page. It's something like 400 times debt or credit is mentioned in the last editions of Security Analysis and Intelligent Investor. So you really can't be a great equity investor and you really don't understand the U.S. economy if you aren't a great credit analyst. And I would say the bulk of this program, if you go to that link in the description, the bulk of this program, this event that we did, where we had, I don't know, I think more than 10,000 people tuned in for it, Albert, um, is discussing why credit is such an important indicator for understanding U.S. equities and the U.S. economy, and why we're so bearish about the next 12 to 24 to even 36 months.
So, Joel, the link is bearmarket2023.com. I think you guys made that specifically for me to make me smile.
That's yours. Yeah.
A link like that coming out of
Bearmarket2023.com.
Altimetry.
That's yours. That's yours, Albert.
It
And so
does
Albert
make
gets
it does
credit
make me
for it
smile.
if if you use that link and watch the event and end up
Yeah.
becoming a
So I
subscriber or
recommend
something.
you check him out. I always enjoy listening to you speak. I've learned a lot from Joel over the years, especially about equity analysis, and I just think you're a professor also by trade, by occupation, and so you're a great teacher. So I hope people
Oh,
check
thank you,
out
sir.
bearmarket2023.com. Check it out. Hear what he has to say. I think this is very interesting. But before I let you go, Joel, I
Yes, sir.
forgot to mention that you are actually also going to be speaking at the royalty and streaming event that Rick Rule and I are hosting on October 21st.
Yes.
And you have now you're not necessarily a resource guy, but you have dealt in the royalty space before. You talk
Yes.
about this. This is something you talk about. So if people come to this event, what can they expect to hear from you?
Well, if the gap accounting is bad for something like a Berkshire Hathaway, right? If gap accounting is bad for Twilio, if it's bad for Victoria's Secret, you can bet that the gap accounting rules are a complete mess when it comes to E&P, mining, natural resources of any kind. I don't know whether it's oil and gas or whether it's mining or even heck, basic chemicals or something. Gap accounting doesn't tell you what's going on, and so part of what we're doing is taking our database of price to earnings metrics of our credit analysis that uses actual proper financial analysis, not the stuff that Moody's, S&P, and Fitch are using, not the junk that Wall Street and all the big banks are using when they publish those sell side reports, and hopefully that'll give us an interesting and different perspective on what's really going on in the space, from a clear lens. The way I would say some of our biggest and best institutional clients would look at this space, at these sub industries, and probably would never share it with anyone. I guess the big difference is, I know I'm not the only one doing my firm, and the 150 people in my firm are not the only people doing this kind of deep financial analysis and forensic analysis on the audio of these companies, of the audio of the management teams. um, but as far as I know, we're the only ones publishing on it with all this content, because the institutional investors that have this content, they don't share it. They don't tell the rest of the world. And we feel that individual and family investors and smaller financial advisors, ought to be able to see some of this, and so we can do this with scale on a far more scalable product, and hopefully they'll see something interesting um, at your program.
Okay, awesome. That's October 21st. It's a Saturday all day. We got Doug Silver headlining the event. It's going to be absolutely amazing. I'm going to put an affiliate link for Joel Litman in the description for this event, so he gets credit. I don't have a fancy domain like royaltyboom2023.com for you, Joel. It's just going to be a simple, simple affiliate link. But please check that out and consider joining us for that event October 21st. It's going to be fun. So thank you, Joel, for this rundown on what you've been doing. I always enjoy following you. And so maybe we agree on this. But there's still lots that friends can disagree on. And I don't know if you want to talk about the macro stuff one day. I think we disagree a lot actually on the macro. Your 30-year forecast for the dollar. I don't think the dollar is going away. I'm not one of those people. I don't think, but I think it's going to take a significant hit in the next
Ah,
several decades.
yeah, yeah. Our call on the dollar, and I'd love to do that. Our call on the dollar is not that it's a good place to put your money. It's relatively better than every other currency's place to put your money, and we have some big macro reasons for that, as well as why we think Pax Americana will be in full swing for the next several decades, and why China and Russia and a lot of other hopefuls. The BRICS is a joke. So if that intrigues anyone, Albert, you tell me
That's what I
when,
want to talk to you
and I'm ready to
about.
have that
Yeah, I
call. I'm
disagree on
ready to
that
have that
one. I
call.
I saw that
Yeah,
interview, Joel. I saw that
yeah.
interview.
On
At
Danny's
least I
show.
saw the
Yeah,
title of it.
yeah.
Yeah, yeah, I saw the title. Couldn't
No,
disagree more.
it's.
We should get back and talk about it sometime. That'd be great. We got to disagree on something, Joel. It can't be just. I mean, it's still fun.
I'm ready when you are, man. You let me know, Albert.
All right.
Happy to.